then when we think about, as a consumer, providing our data to companies or them using our data, whether we know about it or not, for us, it's a good thing that they know more about us, or should we feel cautious about that?
I think generally speaking, it's a good thing. I think the more information a bank has about you, the more informed their decision could be about how risky you are. Obviously, there is going to be winners and losers in the case of a personalized loan with an interest rate attached to it. If you are riskier, according to the bank, you will end up paying a higher price. At the consumer level, I feel there'll be winners and losers, but understanding the risk profile a lot better will make it easier for the bank to decide what to give you. I think there's a group of customers at the moment that, according to fairly simple bucketing measures in place, based on credit scores, for instance, some people banks are not interested in you simply because of a relatively simple risk profile. So particularly for that customer group, sharing data or the bank having more data points on you could certainly be beneficial.
It strikes me, Paul, from everything that's been said, that the only reason that I would have to be worried about companies determining my price based on knowing more about me is if what they knew allowed them to determine that I was a riskier proposition and should therefore have a higher price. And, it strikes me that in thinking about it that way, what you're likely to end up doing then is prejudicing your decision based on poverty or social background or socioeconomic factors. And that seems like something that, regulators and indeed a lot of companies would be very keen to avoid. Is that a problem to kind of being a commercially minded person within a big organization who wants to get this going?
I think you're right to say that the winners and losers, the losers in this case would be people who, according to their more detailed profile, are risky. And where as a society you might start to care about that is when that riskiness overlaps with existing vulnerabilities and customers who can't afford to but still take that out. I think there's an overlap that you need to be very careful on that.
It strikes me that coming back to that distinction, the risk-based personalization versus non, it strikes me that nobody's ever really going to mind if you and I are offered a different price to join a gym. But where it's going to be a problem is where it's banking, finance, money.
I think the example of riskier customers in a non-financial setting, so let's take the gym membership or the subscription-based business, is a lot easier because this is all about willingness to pay, like abilities to pay, because you're not going to default on your gym membership, so to speak. That's not really what they're interested in.
They can remove provision.
They're trying to make sure, well, maybe I need to offer a bit of a discount to this customer because they won't renew at the end of the year, or it's too expensive for them. I'll still make a profit if I give them a 10% discount. I'd rather have them as my customers. I'm willing to do that. And I think that's where the distinction is. But on the financial product side, there's riskiness involved, whereas your riskiness doesn't matter to your gym.